So, can you please take a seat? So good morning and welcome to this last panel discussion, before we move to the really important people after lunch. We're going to come back to the issues which we've discussed yesterday and this morning, and very much hope that we can also connect what we've heard this morning on the micro aspects of price formation and wage formation, and what we've learned yesterday on the macro big picture. And so we're perfectly allowed to come back to questions on the Phillips curve. It's okay. Can come back in the discussion. It's pretty much going to be about the same issues that we've already discussed, but I would very much like to encourage the panelists and urge the panelists to try as much as they can to distill the policy consequences, because that's what we're here to discuss, both at the micro level and at the macro level. And also, I would like to encourage the panelists as much as they can to focus on the European dimension of that discussion, including possibly on the Eurozone dimension of that discussion, given the sequence we're in terms of decisions on the future of the Eurozone. And there is a lot to say about the importance of labor markets and wages also in Eurozone adjustment. So if that dimension can come up in the discussion, that can be very useful for us as policymakers. I'm going to be tough on time, but we have a good incentive structure, I guess, because next item is the lunch. And so all stakeholders here have an interest in disciplining the panel so that we don't steal too much time out of the lunch. So let's start the initial presentation. Erika, welcome. The floor is yours.
Great. Well, thank you to the organizers, certainly, for including me here today. And it's a pleasure to be back in the central banking community, where I spent most of my professional life. But as many of you know, that for the last 4 years, until 2017, I was head of the Bureau of Labor Statistics. So what I want to talk about today is central bankers and national statisticians. And I want to talk about some of the things that I learned as being head of the BLS that I think are very relevant to central bankers. And you see this picture here of Cristiano Ronaldo confronting problems with imperfect statistics. He's butting up his head there. And I figured that this, he may not know that that's what was frustrating him, but we do. So I'm going to go from there and talk about some price index measurement challenges, and then talk about improvement opportunities and challenges, and I think of them very much as part of central bank policy. Okay? So let me start off by saying, well, what is the natural, the appropriate relationship between central bankers and national statisticians? Well, there's certainly the client and provider relationship that we think of immediately, that central banks are very important providers, rather clients of the national statistical system. But of course, they're also very much professional peers, that the expertise, the professionalism of both central banks and national statistical offices makes them natural colleagues in dealing with issues. They have very compatible missions. First of all, their overall mission to broadly support national welfare is very consistent. But their particular missions are quite distinct. They really should be, as President Draghi reminded us yesterday, they really need to be independent of each other in order to preserve their credibility. Right? That's very important. But this independence, the independence is important both in reality and because of optics, right? But this independence shouldn't mean abdicating support for each other. And that, I think, is an important issue. So I'll return to that in a minute. Let me talk a little bit about the goals of a statistical agency. And remember, I put here in the trenches because the important thing to realize is just as central banking has a nitty-gritty aspect to it and imperfections involved in what it does, that's very much the case for statistical offices. So the goals are obviously the best possible official statistics to guide decisions. So why do we have statistical agencies? Sometimes those of us who are data nerds forget why it is we love statistics, but it is because it empowers us to make good decisions, and it empowers everybody in the economy to make good decisions, not just central bankers. And what's good data? 5 characteristics: accurate, objective, relevant, timely, accessible. Okay, I can go into those in great detail, but I think you all understand what they mean. This, though, has to be subject to very real constraints, resource constraints, putting out the data within a time frame so that it can be timely. So when we're talking about the CPI, from collection to production, 20 days, right? And you have to do that every month. You have to preserve respondent confidentiality. You have to avoid undue burden so that you keep response rates up. And because of that, you make changes only when you're certain that they will improve accuracy significantly. Right? All right. So that's the world in which the statistical agencies operate. So when a economic phenomena is noticed, comes up, a very important question to ask is this real or is it a data artifact? And certainly no national statistician would argue against asking that question when the phenomena occurs. But there is a slight difference in approach to this because the central bankers and the researchers will think of this often as a new question, something they haven't run into before. And they'll say, oh, this really demands attention and resources, and let's throw them at the question. All right? Whereas the statistical agencies, by and large, have been dealing with these questions since they created the statistics at issue. Right? So very often, these issues that are brought up are an acknowledged limitation of statistics, because all statistics have limitations, and have been the subject of ongoing improvements of research and institutional memory. So there's a little bit of difference, one group saying, wow, and the other group saying, again? That's the world in which they deal with. They deal with each other, but joining forces can be amazingly productive because the national statisticians bring in this institutional memory, this experience, this understanding, and the researchers, the central bankers have this energy and this focus on it. So with that in mind, let's talk about price index measurement challenges. I'm going to focus on 2 issues that just came up recently. That have been raised recently. One is new goods and quality adjustment bias, and the other is substitution. So we're talking about innovation in price indexes. I'm really going to run through this. The basic approach is to try and match products over time, and so the more closely you can match products over time, the more you can attribute any price change to inflation. That's the basic idea. And this gives you an idea from 1 year of the CPI that in that year, only 2%, that yellow piece there, of the prices in the CPI were cases where quality adjustments were needed. So by and large, price matching really works, but we do need to do quality adjustments some of the time. Here are 3 ways that quality adjustments are done. Producer-provided quality adjustment, that's more on the PPI and import-export prices. Input from other surveys is another source. And then there are hedonic adjustments. CPI uses a lot of that, and housing is a very big part of that. So, but some quality adjustment and new goods bias remains. BLS is always kind of playing catch up on all of this. And a recent paper that 4 co-authors and I put out in 2017, April 2017, in the JEP, tries to estimate how much that is. We come up with an estimate of a bias on real GDP of 0.4 of a percentage point from this bias. We find that there's been little change in this over time. It's real, it's there, little change over time. It's mostly not about the digital economy, it's mostly about healthcare, okay? And it looms larger when, obviously, when growth is slow, then this is a larger part of what you're seeing. From the BLS and BEA perspective, nobody there was actually really alarmed at this, but neither were they satisfied, okay? It has helped to focus efforts. So if you're interested in this, I would point you to that paper. All right, substitution bias. This has also been a long time concern. On average, it causes overestimation of cost of living increases. So to the extent that you want to measure cost of living changes, you get that. There have been ongoing improvements in the CPI to deal with this. And then there's been the introduction of the change CPI to really try and address the substitution bias. And that has a monthly changing market basket. And it also uses the Tornquist formula to allow for more to control for substitution bias. So just to give you an idea of whether that is getting worse or better, you can compare the CPI to the chained CPI. And this blue line is the difference in the 12-month, it's a rolling average difference in the 12-month CPI and chain CPI from the inception of the chain CPI, 2000 up to 2017. And then I've drawn in the red line, just divided the sample in half and said what's the difference. And if anything, the substitution bias seems to be decreasing. Okay. So let me push right ahead because I am running out of time. Oops, I've already run out of time. Okay, so improvement opportunities and challenges. Many opportunities, there's progress being made. This gives you an example of places where progress is being made within the BLS and BEA. Opportunities. The main opportunities that I want to call your attention to are uses of alternative data. And there are really quite a few alternative data sources that are being tapped within for the statistical agencies. I list here some of them, but I think it's very important to realize that none of these sources is free, riskless, or clean. So it actually takes resources to begin to tap into these things. Research is required, comparisons, because these data are so important to so many decisions, you can't go about carelessly changing. Okay. There are also some very important, interesting issues that can be looked at. The role of margins in inflation, I think, is very interesting. The new producer price index system calls out and provides estimates on margins, particularly the PPI trade services margins. I often got complaints about what was this thing doing? It's large, it's volatile. And I think the answer is a group of central bankers and or researchers can probably, now that there's a series long enough, can probably now begin to understand what these margins are doing. And so I encourage somebody to take that up. Another question is work hours. We don't measure and understand work hours very well. I think that there's a lot of room for tracking and understanding work hours. And then a big topic is that I think has been under-researched and that the statistical agencies should be funded to delve into more carefully are our wage indexes. In the U.S., we have the average hourly earnings, which has for which there's a lot of item non-response, so it's smoothed a lot. It's not as good as you might want it to be. And there's the employment cost index, which is composition adjusted. It's a good measure, but it's only quarterly. There are a lot of opportunities, I think, for improving our compensation, not just wages, but compensation measures.
Erica, you really need to conclude.
Now I'm really over. Okay, so conclusion. Let's see. Okay. All right, so we have many improvement challenges. The main thing I want to say here is that there is a role for the central banks to support their statistical agencies. That's very important. What kind of support do I mean? I mean support. We now have statistical agencies under attack for their integrity. Central banks need to speak up for the integrity of the statistical agencies. This is happening certainly in Puerto Rico and in the U.S., but also in Greece, where the former central banker has been convicted of the crime of publishing accurate GDP statistics, right? And many other countries where the statistical agencies are underfunded. And then, of course, they're standing up for the integrity of the data. That's hugely important. So let me stop now because I'm over. Thank you.
Thank you. Thank you very much, Erica. We can come back to any issue in the discussion. We'll have plenty of time to discuss. And in the case of Greece, I would like to, by the way, to confirm that that upholding the independence and integrity of independent agencies, and in particular of the statistical production process in Greece, has been a priority of the European institutions and remains a priority, and that will also be on the table in the Eurogroup discussion tomorrow. Philippe, the floor is yours.
So, hello, everybody. I'm pleased to be with you. So I am from the ILO, International Labour Organization. We don't used to be invited in a central bank meeting. I'm not an academic. Well, I asked twice, are you sure that you... Okay, so I will come back on some of the issues we listened this morning, in particular, maybe about more general trends, and I will have only 4 slides, because I will try to stick to my 10 minutes. So the first is figures that we already... Yep. Voilà. The first figures that has something to do with what we see this morning compares the evolution of labor productivity and wages in advanced economy. Huh? So the data are from 1999 until 2017 for the group of the 36 developed economies. Here, instead of hourly wages figure, as the paper presented in this morning, we use the more widely available monthly wages, and consistently our measure of productivity is GDP per worker. We also deflate, as it has been done this morning, by the CPI and GDP deflator, and we observe the same tendencies that with the GDP deflator, the gap with labor productivity is smaller. But in any case, the conclusion is the same. We see a decoupling between wage growth and productivity growth among the country. We also see that this is not a recent phenomenon. It is a long-term trend that has led to the decline of labor share in a majority of countries in the world, in a majority of developed economy too. In this chart, index real wage and index labor productivity are weighted average. So this means that big countries influence the figure more than small countries. And the figure is very driven by US, Germany, and Japan. In reality, of course, you have a diversity of situation across countries. We listened this morning about France. You can say the same with Italy, where you have productivity growth and wages going together, but productivity is not increasing. This is what we observe. Now, I move to a second slide. Voilà, okay. As it has been said, I think it is very important not to approach wage dynamic only by looking at average, but also the distribution. The centile and decile of the wage distribution experience different evolution a long time, and our calculation and OECD calculation arrive to the same conclusions that wage inequality has increased in developed economy. Obviously, this has important implication because, as we know, high wage earners have a higher propensity to save than middle class and low pay workers. So if average wage grows only from an increase in the top distribution, the effect on aggregate demand and eventually on price might be less than if it is a broad-based wage increase that benefit middle class and low-paid workers. To illustrate the extent of wage inequality in Europe, so I try to stick to Europe, we produce these 3D figures when we rank enterprise in the horizontal axis according to the average wage. We rank the workers according to their hourly wage in the in-depth axis, and on the vertical axis, we illustrate the level of the wage we are speaking about. And what we see in these figures that you have in Europe a lot of workers that are paid less than 20 euros per hour. And these are mostly, not in every country, but mostly the workers for which wage has stagnated. The part on the upper right side corner of the figure have tended to increase more. Some recent studies have emphasized the need to reduce inequality between enterprises, but our figure shows that inequality within enterprise is also very important. And according to our calculation, close to 80% of workers earn less than the average wage in the enterprise in which they work. And within wage inequality count for 42% of total wage inequality in Europe. So it's not ridiculous. This means that reducing wage inequality within enterprise is part of the policy response to wage inequality and the possible impact. Now I will move toward two labor market institutions. I will look now first the contractual arrangement. So over the past decade, part-time work and fixed-term contract have been increasing in Europe. Part of this increase is conjunctural. We look at the figure of Spain, for example. But we see that there is a structural tendency to have an increase of this form of employment. And we expect that technological change will further diversify employment patterns in the future. There is a range of legal instruments that set equal treatment and equal pay for workers in all forms of contractual arrangement, including international labor standard and EU directive. But in practice, as we see in the graph, temporary employment controlling by the characteristic of the worker and characteristic of the job are suffering wage penalty. Sometimes part-time employment feature premium, but that is rarely the case in Europe. In Europe also, part-time employment is associated with wage penalty. And I think we listened something about that this morning. Worker in temporary employment, multi-party employment relationship, and on-call work have little participation in trade unions. They are less members. And more broadly, their bargaining power tend to be lower than standard workers for multiple reasons, including fear of retaliation, sometimes diverging interests with standard workers, lack of awareness of rights. So, and this is very controversial. There is also from part of the trade union movement the feeling that non-standard workers are used not only to lower their bargaining power as them, but to lower the bargaining power of trade unions but I will not enter in that, you know. So non-standard form of employment can help enterprise to adapt to the demand in the labor market, contributing to sustainability of enterprise and growth. But so we are not to get rid of this form of employment, but we want in the ILO to ensure that these jobs are good jobs, where workers have earnings that are predictable and in line with equal pay for work of equal value. Now, I will look at another labor market institution, trade union and collective bargaining, that have also a strong influence on wages, as we listened this morning, but as we know. This shows the evolution of trade union density and collective bargaining coverage in Europe from 2000 until 2016. So it's quite amazing because we see that only 2 countries experienced an increase in collective bargaining coverage during this period. For EU 28, the decrease is of more than 20%, so significant. And all countries, with very few exceptions, experienced a decline in trade union density from more than 10%, with extreme cases such as Latvia, Estonia, or Slovakia, where the decline is of more than 50%. So it is, despite a general discourse that I used to listen in the European Commission, for example, about how important is social dialogue and collective bargaining, we observe an erosion of trade union density and collective bargaining coverage in Europe that is relatively strong. And I would say that often what we observe, it was not the case in Germany, not too much the case in Germany, but often public policies are at the origin of the declining coverage of collective bargaining. So to conclude, so there are different reasons, and we listened some about real wage stagnation. Sometimes it's only a problem of low productivity growth, or sometimes it's a problem of decoupling. And we focus on the evolution of labor market institutions in this area that weaken the bargaining power of workers, because we suspect we didn't quantify yet that this has implication in terms of wage level. I just want to conclude by saying that I am convinced that the decline in the collective bargaining coverage that we observe is not an inevitable consequence of the changing world of work. I think history has demonstrated that collective bargaining has the flexibility and adaptability required to face change. For me, but it's up to the social partner to say, the big challenge is to have modality of employer and worker organization and of collective bargaining that are more inclusive among a diversity of workers in different forms of employment, including the new forms that emerge in the digital economy. I will also say that collective bargaining, to be strong, need good public policy or favorable public policy, and I think there is a lack still of research to understand better how different collective bargaining arrangements can contribute to both equity and performance in the labor market.
Thank you. Thank you very much, Philippe. I mean, your slide on the decline of union coverage and collective bargaining is absolutely striking. I guess one obvious question, you can store it and answer later, but one obvious question is how the change relates to the level. Focusing on France, for instance, the change was limited, but it starts from a very low level. So one other way to ask the same question is, do we see convergence across Europe in terms of industrial relations or divergence, which matters also for the functioning of the region? But that's for later. Tommaso, the floor is yours.
Thank you very much, and thank you for having me on this panel. It's a pleasure to be here. I'm an IO economist. I'm currently working for the European Commission competition watchdog, so I want to give you a sort of antitrust perspective on markets. Competition authorities, what they do, they try to prevent prices from going up. So I understand in this conference a puzzle is why we don't see inflation going up. So I think I solved the puzzle. We can go for lunch. It's because of the job we do. I wish it was that simple. So being more serious now, I will give you some ideas about concentration matters. The debate started a couple of years ago in the US. So this is, but I will present European data. So in the US, there is some evidence that market concentration is going up. What this figure is doing is looking at the change in a concentration index, HHI. And in some industries, this change is very substantial. So in 80% of US industries, concentration has been going up between 1997 and 2014. So that's a large change. Another picture that you might have seen is on markups and margins. This is from the paper of Jan Eckhout and Jan De Leuker. You see that from the 80s, something changed and margins, so the ability of firms to price above cost. There is a big debate on what is the notional cost, but the ability of firms to price above cost has increased. Margins are on the rise. So what's happening instead in Europe? First thing to say is that some companies are actually global. So whatever is valid for the US would be valid for Europe too, because we belong to the same global market. But instead, we started a problem with Europe is that there is less systematic data collection. We are trying to improve. So at the Commission, we have an ongoing project. By the end of the summer, we will have a time series of 20, 25 years. This is just to give you a flavor of it. This is just over 6 years. Concentration in Europe has been pretty stable, so not lots of dynamics. Here you see the 5 largest economies in the EU, plus the aggregate EU. The picture is rather static. At the industry level, some regularities start emerging. So there is huge differences across industries. A regularity here is that you will see that the really concentrated industries, according to all different measures, are telecoms, transport, manufacturing, and finance. Within each industry, there will be heterogeneity, because when I say ITC, there will be fixed telecom, mobile telecom, semiconductors, computers, so it will be different things. So we have to be a bit more precise. Another thing, as you start digging deeper into industries, you will see that in Europe, many of these markets are still largely national. So we don't really have a single market. We don't have a lot of integration. So it's really telecoms in Italy are telecoms in Italy. Telecoms in Spain are telecoms in Spain, and so forth. So we don't have a single market. Margins, that's really where something valid, maybe across the board, starts emerging. So this is our own data on European margins, and they are compared with the US. And you see, apart from striking differences after the recession, and Europe, it took much longer, but if you look at the trends, they are actually quite similar. So margins are on the rise. So in a sense, a takeaway of some of this literature is that no matter what method you employ, so Jan, for instance, is doing data at the firm level and the estimate production function. This is instead from national accounts. This is people using accounting data in different ways. This seems to be irregularity. So this seems to be irregularity. Having said that, don't be too excited. This is the European picture of the 5 largest economies. And the picture is driven by Germany, France, and the UK to some extent. Italy and Spain, now they are recovering margin, but they really suffered after the financial crisis, and margins dropped to very low levels. But they are picking up again. So what are the implications for us, for you? Because we have slightly different perspectives on this. The first implication as an economist, I would say, if concentration goes up, you would expect prices to go up and quantities to go down, ceteris paribus, all else equal. Then we can discuss whether everything else is indeed equal. So these are 2 things. Prices going up, but also quantities. So when you measure your inflation, et cetera, having fixed baskets may be capturing only one aspect and not the whole picture. So quantities do matter. Another implication for a crowd like this one is that to the extent that market power is a substantial feature of the aggregate economy, it needs to be factored in our models. And I'm sure you're already doing this, so I'm not familiar with the way you do macro models, but just think of my thoughts as something that maybe you're already doing, that's fine, but if not, try to see how you may have to change a few things. So account for markups, but these markups are not constant over time. They're not constant across industries. To have kind of simple monopolistic and competition models may not be exactly the way to go. You may have to adjust it. I said this is the prediction, the simplest microeconomics perspective, prices on the increase and quantities on the decrease. Ceteris paribus. So what may have changed, and this is interesting about margins going up everywhere, is that there seems to be a common substantial technological change going on. So the cost function of firms seems to have changed. There are more economies of scale, say, to simplify, higher fixed cost and lower marginal cost. This implies that it's easy to show that you will have less entry, the few firms in the markets will have higher markups, and prices may or may not go down according to how the market power is compensated by cheaper cost, cheaper marginal cost. A consequence of this is also that will be less entry. So one of the big worries from a policy perspective, we have evidence from the US, we start having evidence in Europe. Every year, firms are born and firms die. So these entry and exit dynamics are super important. On the exit dynamics, we are more or less on the same historical trend. So firms die now as they used to die in the past. Instead, firms don't seem to be born as much as in the past. So we don't have these dynamics, these healthy dynamics that we had in the past. So some implication also for you, and this I'm repeating something that already Aviv said, the pass-through is related to market power. So think about the effectiveness of some of your monetary aid transmission mechanisms. Under some conditions, going from competition, high pass-through to less competition should reduce the pass-through. So this is a general theme. The responsiveness of firms changes. This means that monetary transmission will be affected, but in general, responses to shocks will be affected. Can be responsive to shocks in labor markets, could be responsive to entry and exit. So we might have less dynamism, question mark, I don't know, this is really a conjecture. You should also think sometimes, maybe you're already doing that in your models, of the vertical structure, there's upstream and downstream. In the kind of concentrations I'm observing at the Commission, there is lots of boring stuff, but essential stuff. So market power being acquired over cement, over titanium dioxide, raw materials, and you name it. But these will be used by a lot of industries. And if these industries themselves have market power, what you would expect on the final prices would be different. This is not a general result, though. Aviv mentioned, I think, tobacco, and tobacco said this is an industry where the pass-through is higher than 100%. I would say it's a more general feature of some industries where, say, a must-have goods, industries where demand is very convex. We don't have to be technical, but the price goes up, people still want to buy pretty much as much as what they were buying before. So when demand is very convex, actually, the more market power you have, the higher the pass-through will be. So when you're doing your studies, think about the composition of industries. There's lots of heterogeneity there. In most sectors, consumer goods, I would conjecture monetary policy to be less effective, because what I said, the pass-through bill will be lower. But on these essential goods, not only tobacco, but can be transport, energy, they actually the other way around could also be a possibility. And finally, I have my last minute when I want to talk a little bit about digitization. So GAFA, this Google, Amazon, Facebook, Apple. So these are three of these companies will be reaching $1 trillion of market capitalization soon. So do they have an impact in the economy? Yes, of course, but not as large as you might expect in aggregate. We heard this morning that all the digital stuff, Erika said it's being measured, which is great. There is, but just to give you a perspective, is it market power going to increase the prices, or is the super efficiency of these superstar firms going to compensate for it? So using atypical merger simulation model we use at the Commission to simplify, if you have quite a big concentration from 3 to 2, so 3 major players to 2 under some assumption, typically the prices would increase substantially by 10% if costs were equal. And because they acquire market power, the decrease in marginal costs need to be more than 1-for-1. The decrease in marginal costs will need to be of the range of 16%. So just as an order, just as a flavor of what's going on, are these kind of efficiencies what we're observing in the data that could justify the fact that prices don't go up despite market power? Finally, a debate which is more on the Google side. We are paying with our data, so because search is free, or Facebook, we don't need to pay a subscription fee, because then these guys get to know a lot about us, and then they do targeted advertising. So are we not measuring prices right? Here, I would say prima facie, we are already measuring prices in the sense that all this information is then used to do targeted advertising. This feeds into the production function, in the cost function of those firms which are interested to advertise online. So to the extent that these costs are already imputed in our measures, then we should not do double counting, because we are already to the extent that indeed the advertising costs are something that you monitor. I'm going to finish here. Thank you very much.
The last speaker is Klaus Zimmermann. And we're hopping back from product markets to labor markets.
Yes, thank you very much. I have no slides, so you can see me everywhere. Also, I think that it's much easier to interact with the policy issues when you have no structure imposed on yourself, so you have more flexible. Now, what we learned, what we have to do in a panel is to find out what is the policy implication of what we have heard so far on the day. So we have somehow to review what goes on, and I will certainly focus more on wages than on prices. Now we found out, as one finding is that shopping is exciting even without inflation. We also learned that nice unions do it all, at least as long as they exist. And these are some provocative positions already. Now, when I wrote 40 years ago my diploma thesis on rational expectations and the Phillips curves, well, inflation was money, yes? And, well, the Phillips curve was not really existing anymore. Yes, because of rational expectations. Nowadays, it's completely back. We are back, so to speak. The Phillips curve exists, and, well, money is not really relevant. Yes, at least I haven't heard much about money the 2 days. But still, I mean, a simple formula of that time is helpful. Also explain why labor economists are here. We are here. We have a reason to be here. Well, if the labor share is constant, what many of you are doubting, yes, then inflation is nothing more than the difference between wage growth and labor productivity growth. Yes, that's a simple tautological reformulation. So, well, wage growth and labor productivity, these are labor issues, yes. It's only this issue of reducing the labor share, which is maybe not fully labor, but okay. So we, in a way, have a reason to be here, and central banks can learn, I guess, something from the work we are doing also on the micro level. Now, the first issue now is, why are we concerned? Because when I was invited, we are concerned about wages. Wages are not rising enough. Yes, it needs Jens Weidmann in Germany to push for higher wages, not the unions. Yes, Jens Weidmann for years pushes for higher wages in Germany. So really, this is a concern. Why is this really a concern? Now, well, wages are prices, and prices have signals, and signals are important, even if wages would not have to rise, yes? Some of the wages, in general, but some of the wages have to go up, others have to go down to signal changes in structural developments in the economy, to reallocate. And, well, what we also know from research of economists, and one of those is here even, Well, one of those is Truman Bewley, who had written years ago a book and later also articles on it, why there are no wage cuts. Yes, wages are never go down. Wages are always go up if or stays the same. And this has a lot of psychological reasons. So if you want to see signals, wages have to grow because some wages can grow a little bit more, others can grow a little bit less. Yes, so to provide the information. This is already one argument. There are many other arguments why wages should go up, but that's at least from the start something what is very important, very central to the market economy. Now, the question is, of course, what are wages? Yes, well, this is the same debate. What are prices? Yes, somehow labor cost or labor income is divided to some kind of human index. Yes, some take heads, others take hours. But well, if you think about labor hoarding, robots, and all kinds of changes, working overtime, unpaid work, and all these kind of issues, it's not an easy concept. So looking at wages and to see why some countries behave different, or some regions behave different, some sectors behave different, it's very important to see the institutional backgrounds to understand what's behind. Now, yeah, the question is, of course, what determines wage growth? And we are a little bit puzzled, and we learned, not only here, but also here, that the Phillips curve, whether with inflation at the left-hand side or with wage growth at the left-hand side, is flattening at the moment, and substantially flattening, and there's puzzling about it. And the question is, with falling unemployment rates, the issue is, the challenge is issue, can unemployment fall so low, let's say in Germany or in the UK or in the United States, that if prices would have to explode? And well, we had, first we have to realize, and there's the work we have seen by Stock and by Schoenberg yesterday and today, is that there's evidence for flattening of the Phillips curve. There's also work by David Bell and David Blanchflower, recently very fresh new papers. They are arguing that the issue with the unemployment rate has very much to do after the recession with the way how unemployment measures the underutilization of labor. So what we don't measure is that people would like to work more, or previously would have liked to work less, but no longer do so. So they show that people working are not working enough, in their own opinion, and others who in the past have thought they work too much, wanted to work, no longer want to work less. So there is an underutilization of work, and if you bring this into the regressions, you'll find much more stable results. Also, the general finding they show is that we are still flattening. However, they also point at an interesting debate between Keynes and Beveridge, Beveridge already in 1944 was predicting a low unemployment rate, and Keynes was very unsure that this could happen, that 3% is very, very low. Now, in 1960, Bewley reflected backwards, arguing, well, I was not so wrong. And by the way, between 1948 and 1959, in the United Kingdom, the average unemployment rate was 1.5% without prices exploding. So the idea is maybe we should not be so much concerned about that issue, that challenge in general. Now, of course, many factors determining wage growth and explain differences across countries. There are measures, scarcity is of course an important issue, productivity changes. Of course, price expectations, but no longer at the moment. We are now back to past inflation as a predictor of unemployment price expectations. This was once defeated 40 years ago as wrong. And we have, of course, growth expectations driving the issues, future labor markets. Well, if robots will really do what we expect, or some people expect from them, then we will have large stocks of labor in the future underemployed at work, if they cannot be fired, underemployed at work, which is a prediction then that wages also in the future will be low. However, what I also haven't heard much in this conference so far is migration is helping also to influence not only wage changes, but also to make wages adjust smoother across areas. There is research done by saying that in particular in the country of the European, of the Euro, in the Eurozone, the adjustments across countries to asymmetric shocks have increased, which is what we want. And this implicitly, of course, says also that wages would smooth down. Okay, now the last point I would like to comment on is on Germany. Rightly, we have now heard a nice paper and a nice discussion of that paper, which also concentrates on why Germany is different. And I agree with many of the, particularly, of course, the empirical facts are very well elaborated. The question is interpretation. The question is interpretation. I'm a little bit more doubtful that this was all done by unions who like to save the German economy. If one has to be part of the heavy debate ongoing about what is right or wrong, one can have different opinions on this. But then one has to smell that must be more on it. So for instance, the internal, it's true that there is a huge internal flexibility have been achieved, and others, including myself and co-authors, have also worked on that issue. But without a long-term pressure on reforms and changes, these kind of changes would not have been taken place. Also, there were lots of government interventions. So the labor hoarding in the Great Recession organized by the German government was also a measure of internal flexibility. So also it's true that more and more companies no longer follow the union wages. However, theoretically, it's possible. Every ministry, the federal ministry, but also the state ministry for labor, have a commission where one of the social partners can apply for a generalization of the wage contract. It's true that it is no longer done so much, and the question is why. Yes, I mean there is a debate. So also unions behave in a way which are also the German unions. Yes, have to follow interests. Yes, in the long term, they have to also think about wages. They decided to bargain for jobs, but that is. I think a second issue. So the issue of the reforms could be debated more, and I stop here, of course, because my time is over. But I think the reform policies in Germany, directly and indirectly, by affecting expectations and put pressure on all partners in society, have been important. So I would argue, just recommending the German model to France or Spain or Italy by saying the unions have to be more constructive is, I think, not an export good which will be successful. That would be my prediction. Thank you very much.
Thank you very much, Klaus. Let me give a chance to the panelists to react to what we've heard before I turn to the floor. If you want to, if there is anything you want to say? No? No?
Let's go into questions.
Okay, good. So let's go to the questions. Let's open the discussion. I will take the questions 3 by 3, and starting with Richard Portes. And please introduce yourself, nevertheless.
A question for Erika. You referred to, you scraped over very quickly the question of scrape data.
Yes.
And I'm a little bit familiar with the Billion Prices Project, which seems to be a rather impressive effort. And I'd be interested in your comments. I mean, you said not free, riskless, or clean,
yes.
I think. Well, yes, but okay. Maybe you can give us a little more detail on on the comparison between that and U.S. CPI data, and because there are periods, if you look at the indices, there are periods in which there is significant divergence, but over time, they one catches up with the other, and do those periods of difference tell us anything?
Thank you, Richard. Maybe one additional question to Erica, if I may, when it comes to web scraping and big data generally, is about representativeness of the samples, because there might be an illusion that when you have very big data, it has to be representative. You know, it's like in this Jorge Luis Borges story where the ultimate map is the country itself, right? So if you get all data, it's representative. But big data is also subject to sample bias, adverse selection, and the like. So I would like to know more about it. Luigi Zingales.
Yeah, Luigi Zingales from Chicago. This is a question mostly for Tommaso. In fact, is a point, because I'm sure you know that. But you dismiss, like a joke, the tension between macroeconomists and IO. Macroeconomists say, no problem because prices are too low, they don't rise. And then the problem of IO economists has been solved. Now, as you know, and you pointed out in your data, IO economy is concerned about margins, not about price levels. Macroeconomy is concerned about price levels. Why do I say that? Because I've seen people dismissing, for example, concern about the telecommunication industry in the United States. Because if you graph the price has been going down, and concentration has been going up, so say there is no problem. Reality, if you look at how much prices drop, they drop much more slowly than in other countries. And I think that's the reason the concentration generated that. But then there is another interesting question that is more for the macroeconomists and actually for the ECB, the central bankers, is we know that the reaction to price increase and decrease is very different. So if you look at gasoline, whenever there is a price drop of gasoline, the gasoline pumps are less prompt in rebating it, price increase is more. So to what extent the inflation targets impacts actually the IO of pricing of companies, to the point that favors tacit collusion in a moment in which you have a reduction in cost due to innovation, and then the fact you have the low inflation targets allow firms to keep prices constant in face of dropping cost, and so favors collusion.
Thank you, Luigi. Let me take a third question here, please. And sorry if I can't identify you, but you're just too far away. Central bankers only have a medium-term horizon, as you know. We're not that far-sighted.
Thank you. Central banker is here. I'm Oscar Arce from Bank of Spain. My question is to Tommaso as well. And it's in connection with the relation that you established between markups and the pass-through of monetary policy. You essentially said that at some point that the fact that markups are now higher may imply that the pass-through of monetary policy may be lower. I must say that I found the argument a little bit unclear. In principle, you may have a high level of markups, but these markups are still being very responsive to some shocks, including possibly to monetary policy shocks. So my first question is a clarifying one. I wonder whether you can elaborate a little bit more on this, because it may be an important issue for central bankers, given the evolution that you show us about markups. Now, I think that there is another channel that may affect the pass-through of monetary policy and the effectiveness of the measures deployed by central bankers these days, which is the one linking higher markups, profits, retained profits, and the financing of investment by non-financial corporates. Now, what we have seen over the crisis is that in some cases, this was true in the US, markups have been strongly countercyclical. And in the euro area, markups were countercyclical precisely, or more countercyclical precisely in those countries that were more severely hit by the financial crisis. Actually, in countries like Spain, Portugal, or Ireland, markups went up in the worst part of the crisis. And some of my colleagues have documented that this phenomenon was particularly intense in those firms that were more financially constrained. So what we are seeing these days is that markups are going up, that firms are able to finance an increasing part of their financing needs through retained profits. My impression is that this may eventually erode the effectiveness of monetary policy. Think about, for instance, German firms. German firms have been recording a substantially positive net financing capacity. They are net lenders to the rest of the system in a relatively large amount. And we have seen this before in countries like Japan, and we are seeing this in countries like Spain these days as well. So essentially, this is telling us that firms are not investing much, given very loose financing conditions. They are piling up a lot of cash. So in this context, perhaps we should expect that the small changes in the interest rates engineered by central bankers perhaps are not going to have a big effect. But I would certainly like to know your views about this issue. Thank you.
Okay, thank you. Let me turn back to Erica and Tommaso. Let me remind you that there is a trade-off between the length of the questions and the number of questions. That's for the next ones. Erica, please.
Okay, so that's a really interesting question, with a comparison between the CPI and the Billion Prices Project. There are two general points that I can elaborate on. The first of all, that official statistics are transparent in a way that will always be inconsistent with protecting profit-making intellectual property. So their Billion Prices Project, as good as it is, will always have some proprietary methods that you will never be able to examine and know, because they have to protect their secret sauce. The second thing is that there are data limitations from web scraping that Billion Prices solves by relying on official statistics. So they use the Consumer Expenditure Survey for their weighting. They use CPI numbers for all of the products and services that are not posted on the web, all right? And they use the CPI for validation and for benchmarking. So they are very much an extrapolation, interpolation in some ways, of the official CPI. A complement to it, useful. They put out some products that are tailored to special needs that people are willing to pay for, but they are not a substitute for the CPI. And now, in terms of web scraping in general, well, it depends on what you scrape and what you scrape for. The CPI program does use web scraping for many of its hedonic models now, because that's the cheapest way to download information on product characteristics these days. And so that's very useful. It is experimenting and thinking about how to scrape prices on an ongoing basis. But the problem with that is twofold. One is informed consent issues. Right now, if you participate in a survey, you know you participate in a survey, and you have promises from the BLS on how that information will be treated. The legal issues for consent for web scraped information haven't been worked out. And I'll tell you confidentially, Census and BLS have different advice from lawyers on this, so it hasn't been worked out. And along with that is that there are high fixed costs to setting up a statistical process to produce dependable data. If you build your process around something that might disappear, that you have no control over, then all of a sudden you may not be able to produce data of reliable quality when that happens. So there's some big barriers. Generally, I see these big data projects as useful for the statistical system and obviously for the people who pay for those products, but they are a complement, not a substitute for official statistics.
Thank you for the questions. When you are an official of the Commission, you develop a skill in deflecting the question and you answer on a slightly tangential way. So I'll try this skill if I have acquired it.
You'll never be as good as central bankers.
So Luigi, yes, absolutely. But I was thinking of the trends. So I wasn't comparing levels. So trends are common. Some trends are common across US and Europe. The fact that some prices are higher in the US, I do agree. I'm really worried when when the head of the antitrust division of the Department of Justice is saying that there is no evidence that a fourth mobile firm in markets reduces prices, or anticipating that the next merger wave will be approved. Luckily, in Europe, I think we are slightly more independent, maybe by design, because we oversee 28, well, soon 27 different countries, so the system of revolving doors is not the same as there. So, but I would be more concerned about your bill than your bundle in the US. Expectation about inflation. So I do observe a lot, especially in so-called declining industries, or this basic stuff. So for instance, recently we had a merger among tau producers. It's a disgusting product. Tau is the thing you made the cigarette filter with. And cigarettes are declining because worldwide, apart from a few countries, going down. And so they said you should allow us to merge from 3 to 2 because we'll be able to rationalize capacity. And we said this is not the right counterfactual. So sure, you will have to rationalize capacity anyway, but sure, if we want to increase prices of cigarettes for health reasons, we have different tools. And the merger was actually blocked. So, but we see a lot of this that sort of implicit collusion going on, especially in declining industries of homogeneous goods. On the question deflection, I guess, the purpose of what I said was to throw some ideas into the modeling of macroeconomists. As I said, most likely you are already doing it. If you don't, perhaps think about it. To clarify, the link is not between margins and pass-through, but it's between concentration and pass-throughs. If concentration increases, pass-through are predicted to go down. But if concentration increases, also margins, so indirectly, there is also this kind of correlation. What's interesting for me, since I am on the antitrust side, is to see the effect to which monetary policy, what you do, affects what I'm doing. So since I'm observing an unprecedented, at least in the last 20 years, wave of M&As, of mergers and acquisition, I wonder whether the monetary policy, to the extent that it gives a cheap credit to firms, especially to very large firms, these firms want to acquire other firms instead of doing organic growth, which is what we would prefer from a competition point of view, question mark. I would like to hear your views, in fact. And also another mechanism I'd be interested in, again, if you provide cheap credit, you may actually induce less of this industry shakeout that we had in the past. So in Europe, did we keep too many inefficient firms alive? I don't have an answer to that, but I would like to know to what extent monetary policy can affect that.
Thank you. Let me take another round of questions. So we had John Milbauer.
Thanks. John Milbauer. Tommaso Valletti made some very interesting points, and they link with the discussion this morning from Aviv Nebo on concentration. I think you said, Tommaso, that you assumed that macroeconomists would have taken concentration into account in their inflation models. Well, actually, I think that would be the wrong assumption. I think part of the reason why they haven't is because they've been focused on inflation models where the price level doesn't matter. And of course, concentration and markups affect relative prices. So if we think about inflation as partly a process of relative price adjustment, then concentration and markups become an important part of the dynamics. And the work that you're doing at the Commission in terms of providing data on concentration at a national level going back 25 years, I think that's going to be really valuable in improving inflation models. And the Groshen paper that you cited for the US, for the first time, gives us a comprehensive Herfindahl index going back to 1970 or 72. And actually, Janine, Aaron, and I have been modeling US inflation, and it turns out this is actually a useful part of the model. So it affects relative prices. So union density, so worker power and firm power are part of the process of relative price determination, and that in turn affects inflation dynamics.
Thank you. Sebnem Kademsi-Oskan. And then we'll have Charles Wiplosh, and there will be a last round of questions.
Okay,
Don't worry.
Şebnem Kalemnovskian from University of Maryland. My question is for Tommaso. I want to compare, well, I want to ask you in terms of the work you are doing for Europe, how it is different than the US, because I want to compare US and Europe in this whole markup business. What we know by now is the markup increase in US is driven by large firms. In fact, if you look at the census firms, you don't find much. And the new work done at the fund for European firms pretty much coming with the same conclusion. Last year in Sintra, we also see the differences between Europe and US. Okay, this says if it is about large firms, we should be thinking about antitrust and mergers and acquisitions and all those things. Now, coming back to Europe, part of that is also integration within Europe, right? Like the foreign mergers and acquisitions across the border. And that's something that is desirable and wanted and supported by the policy since the introduction of euro, because that's going to bring risk sharing, equity financing, and all that. So my question is, this work you are doing, looking at the increase in markups, large firms, all firms, did you see any role for foreign firms? When we have more, foreign acquisitions across the border, Germany and France, if that top 4 firms driving the ratios, are they all foreign? And what will be the implications for that? Because that's something I believe we want in European Union.
Okay, Charles?
I just wanted to react to John Mühlbauer. I don't understand the reasoning that when we think about inflation, we should care about relative prices or markups or all of that. If these things change, they change once, and the change can last for 2 years, 5 years, 10 years. But you cannot imagine that markups keep going up or keep going down because they would hit the limit. You cannot think that concentration will keep moving in such large amounts. So at the end, these are temporary effects. And the central banks that care about the medium run are very unlikely to see any impact of these things. And I'm afraid there is a lot of confusion building up, or unless maybe I am confused. But I think this is something, and I think Ricardo raised the same issue earlier on. So we spend an enormous amount of time discussing these things. But at the end of the day, the impact of inflation may be beyond 2, 3, 4, 5 years is likely to be negligible.
So to put it differently, does any of what we've been discussing over these 2 days matter for monetary policy?
Let's have a poll.
Back to the panel.
That's the poll for the day.
Tommaso, you want to start?
Yeah, so thank you, John. Thank you for this comment. I think no matter what your opinions are, it's great that we're discussing about it. So it's true also before somebody said we're typically not invited in this kind of fora. I think it's excellent that the ECB in the past it's collecting data. I know there is an effort done by ECB to collect concentration indices, and the fact that we are here together can just be a positive thing. What we're doing in particular at the Commission is twofold. We are gathering information about firms in plausible antitrust markets, because for me the market definition is an important exercise. So where products compete. So it's not so 3-digit level industry would be to aggregate for me. So we are doing something to do a market reconstruction exercise, which is not an obvious one. And then we are doing also a collection or a systematic collection on the margins of the firms that we observe, which is a very selected sample, because obviously the Commission is looking at super large kind of mergers. So Bayer Monsanto, $100 billion. This is not the average firm, but we do observe that margin for those large firms is on the rise historically. We know less about the smaller firms.
Erica?
Yeah, I would say also that the theoretical foundations of many of our models assume a market structure that's more or less competitive. And if we are going to a world where that's not generally the case, then we should expect some changes in the behavior of variables that we care about, because we have actors who are no longer in a competitive market. And so I think knowing what's going on in how markets operate has got to be very important for conducting monetary policy, because it gives you an idea of where to look and what sort of relationships might be changing.
Thank you. Klaus?
Yeah, just coming back, Charles, to your question, what can we say from they're discussing? So one example is minimum wages, where I think the long-term effects are very important also for pricing. Because as in Germany, we had no minimum wages because the trade unions for many years didn't want minimum wages because they were controlling the wages anyway. Now, since they no longer can control it, that's why I was in meetings where the trade unions said we need the minimum wage now because we have no other way to influence wages. And this is not only for the poor; it's also for everybody because if you push minimum wages high, then all the other wages also hopefully move up. So it's about a long-term strategy to move up wages. You may be in favor of it, against it. I'm not judging this at the moment. I'm just saying. So now the Commission in Germany we have is making proposals every so to speak years or so to increase the minimum wage, and by that lead the debate about how the wage structure should develop. So that's something what at least has to be observed by central banks, I would argue. Okay.
One of the interesting arguments made is that if you let the minimum wage sink low enough, then it can become a tool of employers. It becomes essentially a monopsonistic tool. They can all set their, implicitly or explicitly, decide to set their wages to it, and then it becomes a way of collusion. Providing a method for collusion when there isn't an obvious other mechanism for it. And in that case, then raising the minimum wage, you could get actually increase in wages and increase in employment at the same time. And if you didn't understand that as being a part of a labor market, you could be quite confused by watching wages go up and employment go up at the same time.
Thank you. Philippe?
Yeah, maybe in line to what you say. For example, in Europe, in UK, you see that the wage profile in the decile is rolled down by minimum wage because basically employers use minimum wage to pay the minimum they can. So the curve of the median the distribution of wage distribution in the UK is like this, you know. So this is a tool that can be in double effect. Positive or negative for workers?
So let me take a last round of questions. I already have 3 questions, so let's consider the list is closed. So starting with Ricardo Reis.
Sorry. So with the start of the banking and monetary union in Europe, what we observed was enormously large capital flows from the core to the periphery, and this is in between 2000 and 2005 and 2006. And what we observed as well, which was, I think, quite surprising, was that this coincided then with a complete stagnation of productivity in Portugal, Greece, Ireland, many countries. And that has led many macroeconomists who have used IO tools and said that there was an enormous amount of misallocation of these very large capital flows from the core to the periphery, and to see in that a beginning of where the euro crisis started and many of the problems that then are still afflicting us and led some of the discussions earlier. Now, a difficult, and so Shebnem, for instance, has worked quite a bit of this, and so have I. A difficulty that we've had in macro, and so for the IO economists exactly, and where could you help us, is while we observe the markups, we observe the concentration, we've gone and measured, we've used the IO tools, but we have difficulties understanding what's the source of misallocation. From the perspective of capital, not from the perspective of market power, but from capital. Is it that financial systems in Portugal or Greece weren't mature enough to allocate this enormous influx of capital that came from the core? Is it that banks weren't sufficiently regulated or benefited from too low interest rates or lax monetary policy? Is it that governments intervened to protect some sectors and some companies and some incumbents who were powerful? Or is it that antitrust authorities didn't do their job or not? What way can you enlighten us in this debate and use maybe the IO tools, i.e. linking the macro capital flows to the misallocations as opposed to the more micro concentration approach that, say, Luigi or you were mentioning earlier?
Okay, one question here. Yeah.
Jan Eekhout, University College London. I just wanted to pick up on the point that Charles made. I agree that if this is temporary, the increase in the markups, then it shouldn't matter too much for monetary policy. The issue is, or the facts are that, you know, it's been going on for 40 years. And the increase in the markups are by about 40 to 50 percentage points. So we're going from 1.2 markup to 1.6, 1.7. And it's not just that we see it there. So that's 1% a year on additional inflation, if you want, if that would be the economy aggregate. But we see it in the decline in the labor share, which is consistent with that, because it's basically the reverse of the same effect. And we see it also, something that hasn't been talked about much in terms of firm profits. In the US, firm profits, at least for the publicly traded firms, has gone from 1% of sales to 8% of sales over that same period. Now, again, that's consistent with this increase in market power, but the point I'm trying to make is that this is not something that's just very short. Okay, this has been going on for 40 years, and the pickup has been going on until now. In fact, for the last 6-7 years, the increase has been the most steep. And then the last point is, it's the same story in Europe. At least we look at the publicly traded firms, and in response to Chesnam's point, the European firms have the same story. There's an increase of about 40 points in markups and also in profits.
Thank you. Can you pass the mic to Michael for the last question?
Okay, so I have a really quick question for Erica. I'm fascinated by first-degree price discrimination that's becoming sort of rampant on the internet. And whenever I go on to Expedia, I have my wife do it at the same time, so we can see we get the same price offer. Mm-hmm. So how does the BLS even dream of tracking that? I mean, this could be changing over time. I mean, I think these firms are getting more and more important, and I think Amazon is probably also practicing some type of first-degree price discrimination. They know my credit card, they know how much money I make in print or how much I spend. How do you deal with that?
So I actually don't know that in particular. I mean, I know how they price. I actually watch them price utility costs and telephone services using the internet. And in that case, they signed on as if they were a customer and put in their request and saw what the price would be. So I assume that that's what's going on as well. So whatever those cookies are reading these characteristics as is probably getting the price. But I don't know that anybody's looked at it, and I would think that that would be quite an interesting project.
Thank you. Tommaso?
Very quickly, on first-degree price discrimination, to the extent that it exists, I just want to make the abstract but interesting point that pricing would be based on willingness to pay, so just on demand-side consideration, and costs are completely disconnected. So monetary policy is lost forever in that kind of world, because prices don't react to cost, which is just, again, before lunch, food for thought is always interesting. To Ricardo, again, we can continue this discussion, obviously. But in terms of misallocation, one, I've already said, to the extent that investors follow profits, they want to make money, instead of organic growth, where you have to compete against someone else, you're just going to acquire companies. There is evidence of these mergers which are killing some particular companies. So they all, especially in the biopharma industry, the old adagio was the small guys should be bought by the large guys because they don't have enough capital, and it's going to be supplied by the large guys. In the data, we observe that's true to the extent that they are not competing against each other, so the research projects are completely disconnected. If instead the research projects are very close to each other, as you might expect from another point of view, the small guys are being bought, and then the project is discontinued, which produces a misallocation. Another misallocation could be in terms of inputs. I said think of the vertical structure. Market power is on the inputs, so there may be the wrong choice of the inputs that then also trickles down to final prices. We have a consumer surplus benchmark in our merger analysis, but I can see some of this mechanism. But again, thanks a lot for your observations.
Just one note of caution, Tommaso. Monetary policy is not only, even not primarily, I would say, acting on cost. It's about acting on aggregate demand, right? So just one note of hope for us.
Absolutely.
Thank you. Klaus, Philippe, one last word.
You mean?
One word of conclusion.
One yeah. Conclusion? Well, inequality was an issue which we have also covered, which is relevant. I think that what we have seen in many countries, including Germany, is that the brighter spread in the wages is not necessarily an inequality issue, because we have to conceive this in the context of households and of income households in total have. That's one important aspect, and also what Michael already mentioned, that and also Uta Schönberg that if low-skilled people get a job, they have low wages, and this doesn't mean that it's not worse that they can get these jobs. I think that's very relevant to understand.
Philippe?
Well, I think one of the things that we didn't touch so much that is important with inequality is inequality between groups, women, men, migrant, national, and I think this is an important dimension in terms of policy response. Our next global wage report will be exactly about decomposing gender inequality in terms of wages. And for example, in the last report, it's interesting to see that the general gender gap controlling by the characteristic of women and job is around 20% in Europe. In the first top 1%, it is 45%, or 47%.
Thank you for this last remark. Thank you very much to the panelists. This was a fascinating discussion. I guess the only conclusion is that it's about the beauty of general equilibrium, that it takes labor economists and competition and IO economists to say something meaningful on prices. So that's the conclusion. Thank you very much.
Thank you very much. We'll be